Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. Just when you thought it couldn't get any crazier, let me tell you, we have gone a step up. This video is going to be absolutely jam-packed, and I say that a lot, but right now it's as if I cannot fit it in. It is crazy to say the least. The first thing I want to look at is the Haywire Markets. I will show you what you need to know. The second thing is buy the Russian dip. Many people are starting to say now's the right time to get in. In fact, JP Morgan is one of those groups. But we'll look at the deeper levels of that, and I think people should be aware. The third thing is what's up. What is up right now? Of course, what is down as well? I will show you all of that and more. Let's begin right here by seeing what we have broadly. You know that Putin, you're probably aware already, saying if you put the sanctions on, if you impose a no-fly zone, that is a declaration of war, and officially NATO would be at war with Russia. This is huge, obviously, and we will see if we get to that step. But remember that above all else. At the same time, there is a little bit of, talks from both sides. Let's make things happen. Let's cool our jets for just a minute. So as this progresses, things are changing daily basis, but I think it is important to realize what's happening around all of this as I cover the information today. Russia energy chaos triggers the biggest market shock in decades. Disruption resembles oil crisis of the 1970s, according to Goldman Sachs. An array of vital commodities have shattered price records. You know all of this, of course. I've got some charts in here. I think it is important to see, what happened in the 1970s. It could happen from one factor or another. It could be geopolitical. It could be some financial elements. You see the effect on people. And that's the issue. When the prices rise dramatically, the consumer mindset changes a lot. And that's very important. Okay, so here we have crude dependency. Most of Europe's eastern countries still depend on Russia for more than half of their crude imports. And you see how much influence Russia has in this way. So that's key, okay? You're just seeing that here on this map. Russia is being disconnected from the world economy. The process that began in the 1990s of Russia connecting with the world economy, being integrated with the world economy, is very rapidly going in reverse. I'm not so sure because of the dependence that, especially a country like Germany, which we'll talk about, has. They can't just flip a switch. They can't just do that. But now we are realizing in many ways, look at what happened during 2020. Oh no, or even before that, I should say, with the tariffs. Okay, you had the tariff issue. Oh no, we can't, just deal with China. This is a huge issue. Then you had 2020. Oh, we make products overseas. Oh my goodness, we need to get products here now. We need the hand wipes and sanitizers and all this stuff. There was this huge backlog because we were always trying to believe that we can import everything and that's going to be okay. It is okay until it isn't. We're realizing that right now. Ships needed. Russia depends on ships for about 2/3 of its crude exports. So you can see the difference there by ship and by pipeline. Okay, so it just goes through. There's a lot in all of these that I'll cover today, but I've got specifically a lot of charts. I know everybody loves the chart GPS. If you do, hit that thumbs up. Putin seeks to avert defaults with ruble payments to creditors. Debtors can set up accounts in Russia to pay foreign investors because you see they're locked out of the markets right now. They don't have what they had previously. That access is diminished, and as a result, they say, "Hey, set up an account over here. You can get paid in rubles." Now, I don't know if somebody wants to get paid in rubles right now because, quite frankly, the value continues to drop. If we start to bottom out, and maybe they'll feel more confident, but we'll see. Rosneft and Gazprom governments have dollar payments due soon. So I'm going to track this for you, and of course, we'll see what happens. The bond market, really key to watch, as well as with what the companies themselves do. And we're going to talk about some of those companies and what they're planning right here. Okay, so it just shows you the details of this as well, but I think I've made my point very clear. stock market's denial trade on Russian invasion is buckling. Drop in equities undermines the idea of a short-term impact. Sanctions will isolate commodity powerhouse from the world economy. Essentially, what they say in here is that this is going to be prolonged. It's likely not to be done in a week or 2 weeks. The effect that we are feeling right here is to be prolonged. Therefore, commodities will go up. Therefore, there will be this more disruptions. That's what they're saying. Okay, and it makes a lot of sense, certainly, but we'll see. Commodity powerhouse Russia is in a different league than countries sanctioned in the past, and you can see the value of the annual exports on the right. That's Russia, but you look at Iran, the next one in line. I mean, it's not even close, not even close. So that shows us nearly 400 billion for Russia, big money. Okay. So if you see on the sanctions, like a country like Venezuela, it doesn't have as much of an impact, but suddenly you sanction Russia and their companies and their central bank, and then it starts to hit a little bit harder. So we'll see what happens, okay? It is interesting that the market did not believe that the war would start a month ago. Then we did not believe that it would escalate it past the regions in the east. So it is a bit of a denial trade. So those areas in the east initially, okay, it's going to stay here. That's what Putin had said. And then clearly not the case. So the market kind of was a little bit, I guess, as they say, that denial trade. Losing out, European stocks fall to the lowest in a year as war escalates. So this is also going on in the S&P 500, as you can see, but European stocks being hit harder. And there's obvious reasons for that. They mentioned the ripple effect, which is something I talk about all the time, and that is key. Beyond energy, there's also the risk of shocks to other commodities given global linkages of all types of input chemicals. So far, however, these issues remain contained and are likely to be manageable if the conflict and resultant production issues are short-lived. If it stretches on, the ripple effects will be significant. And that looks like it's likely going to be the case, okay? So you can see here, war footing markets are pricing in a boost in defense spending after Russia's invasion. I mean, I think that's pretty obvious. Around these times, a lot of money flows in. I do believe that there's a moral aspect. So, if somebody doesn't care about the morality situation, yeah, that would have been a great buy. You could see that as very obvious. Just like the pharmaceutical companies back in 2020, it was extremely obvious. But again, based on your morals and ethics, that's all. Russian stock dumped for 1 cent shocks retail investors on eToro. Should we buy the dip? That's the question. Well, this is one example of what could happen. The trading platform told users that it would liquidate positions in Russian supermarket operator Magnet, leaving many saddled with large losses. So I don't know what's going to happen broadly, but you can see what could happen. That you're basically just holding onto worthless stuff. So that is a big concern. Now, this is not some of these massive companies. What about the ETFs? You might be asking about that. Well, let's look at that. There's another article I'll cover in just a second. And you can just see they go through this particular instance, and I don't think that that's going to be a big issue for a lot of people. But I'm more interested in the other one. I just wanted to show you here, we are currently in an unprecedented geopolitical environment, and the resulting impact on a number of instruments means that in some cases they have lost their entire value and or are subject to exchange intervention. Situations like this might be considered as exceptional events which require us to take actions that we normally would not. But here is the big one, okay? What happens to indexes and funds that need to dump Russia? In fact, I want to do a video just basically reading through this thing because it is important, because I know I've heard from you. Understand, I read all the comments, okay? I try to give at least a like and heart to as many as I can. This right here is something that, I should just read right through. Anyway, just look. I've heard what you said. Should we buy the dip? Is this the time? I'm going to buy the dip, and all these things. This basically just talks about, why being in an index matters. You've got a lot of money flowing in. In this case here, they're talking about nearly $1 trillion in assets going into these things. In fact, if you look at it broadly, you're seeing trillions and trillions of dollars of money just flowing in. A lot of that is passively being invested. So they're going in and buying up whatever's part of that index. Why are Russian assets being removed? They are considered to be uninvestable. Okay, so you're seeing MSCI in this case here. They're cutting Russian equities from its widely tracked index, emerging market index, right? Currently uninvestable. That's their quote. How do they get removed? So this is, getting into more details. In more normal times, exchange, they announce it well in advance, it's on schedule, and so on. It's not going to have a big impact. This, you would see that, ExxonMobil being kicked off the index, for instance. These things do happen. The plan to remove Russian assets from their indexes all vary slightly, but the steps are roughly the same. The value of the securities will be written down to zero, and then they will be deleted. That's it, you're gone. Zero, deleted, gone. What would this mean for securities given the boot? They'd effectively be cut off from large swaths of the investing world. But understand, it doesn't mean they just disappear from existence. It just means they don't have the money that was coming in before. If you're not part of the index, that's where all the money is today, passive investing, then you've got an issue. Okay? They'd effectively be cut off. Even at the declines, Russian assets make up a little more than 1.5% of the weight. So it's not a big thing in total if you're holding on to those ETFs. But I do believe that it's a concern for those wanting to get into these Russian ETFs and so on. They're just saying, will they do this en masse? No, not going to happen. Not really likely. Okay, what about Russian-only ETFs? It's a little more complicated. The structure of the ETFs mean they are still trading even with their assets stuck, causing gaps to open between the price of the funds and the value of the holdings. These ETFs can act as a vehicle to help value the underlying securities when they can't trade. This has happened before, Greek Stock Exchange, Arab Spring, talking about all of these, okay? Does it extend to ESG investors? They just go on, okay? I don't have time, but you see what happens. Things can get really wacky very quickly. Bond traders prime for wild swings with inflation war in focus. Treasury market volatility surges to a March 2020 level. Yield curve flattening trends extends with rate hikes in play. Big, very big, in fact. And you could see that right here. You're looking at the MOVE index, which I think I have another chart to show you in a minute. But that MOVE index is basically volatility within the bond market. And you see it's truly excessive right now. You don't have these type of events happen too often. It's not really a normal occurrence. Copper has shown a modest price reaction so far to Russia's supply risk. Isn't that interesting? So you're, of course, seeing palladium, you're seeing oil, but copper hasn't reacted. Now, does that mean it's one of the, those that will come up afterward? Some are starting to say that that could be the case. I would say, at the very least, keep an eye on copper. JP Morgan analysts tout Russian company debt recovery play. That's right. JP Morgan saying, get in to Luke Oil. All right. Could be holding on to nothing, could be good. That's up to you to decide. I just wanted to show you what JP Morgan is saying right now. European stocks clearly getting a beating. You see all this red? 16% to 23%. You see all that? 1 week performance, 1 week for European stocks like Mercedes-Benz and Porsche, Volkswagen, Deutsche Bank, everybody's favorite. I don't even know what Deutsche Bank is at today. I mean, how does it have any value? Anyway, you're just seeing that. Look at what could happen in a week. 20% of already being beaten down. You see the buyback authorizations. This is big because, of course, when there aren't any real buyers, the stocks can buy themselves up. A little bit of ridiculousness, but that's the case. And by the way, $1 trillion, the expectation for this year, $1 trillion. Ratio of S&P 500 tech to energy stocks, while it was way, way out of whack, I mean, whatever, let's say a year ago or more, now it has come back down a little bit, but we will see what happens. It looks like, just happens to look like, that will come back down to earth. Russian oil's next big test, trying to sell 83 million barrels. Uh, Big stockpile. If they're out of the markets for a while, what happens? Here they're trading at a very big discount compared to Brent. So we will see, of course, when and if the markets open up, who's going to be their big buyers? Let's see. Okay, is China, they're going to do a big deal with China? Anybody that wants to do a deal with them right now is going to, they got the optics and they're going to be looking at them saying, hey, you're bad. So we'll see what happens. Global trade and financial links also having been plateaued. They're talking about globalization, how we're losing that globalization, and they're saying it's a bad thing. Here, just showing you at the bottom, financial markets that once rose and fell near lockstep are increasingly going their own way. A decade ago, markets in different regions moved together about 80% of the time. Today, the correlation is a bit more than 50%. So you could see how, Europe's going this way, the US not so much. You look at different areas. I mean, Brazil, I haven't checked in a little while, was going up like crazy. I mean, it really all depends today. Everything's up in the air. Fundamentals are out of whack. China says it seeks to resolve Taiwan question amid comparisons to Ukraine. We're going to tell everybody what we plan on doing. We're going to make sure that, hey, it's going to be okay. We will see what happens out of the report that they produce. I will bring it to you. But, I just think for a lot of people, they should be paying very, very close attention to what's happening in China with Taiwan, because there has been a lot of tough, very tough words, to say the least. Now, that's it. Big video. I had way more to cover, and I'll have to do that in a separate one. We'll get that on tomorrow. A lot of good stuff here. If you appreciate the information, hit that thumbs up button. It's right down there below. And are you subscribed? No? How can you not be? This is the most jam-packed, relevant, up to the minute information that you can find. All you got to do is click that subscribe button, hit that thumbs up button, and I'll see you on the next one. Take care.